You don't feel it happening. That's the entire design. Every month, money leaves your account through mechanisms so normalized, you've stopped questioning them entirely. It doesn't feel like theft because it arrives dressed in policy, in terms of service, in that warm, familiar branding that tells you your bank is your partner. Security, trust, growth. The language is always aspirational. The imagery shows you a future version of yourself that is calmer, wealthier, more secure. But strip away the legal framing and you're left with something simpler, a wealth transfer machine so efficient, you've been trained to thank it for the privilege. This is the invisible tax, and it does not require your permission to operate. The weapon isn't a single giant charge. Giant charges make people angry. Angry people call customer service. Angry people switch banks. The system doesn't want your anger. It knows anger without direction is just wasted energy, so it avoids the big charges entirely. Instead, it uses the small fees. The $3.50 monthly maintenance charge, the $2 paper statement fee, the $1.50 account inactivity penalty. These numbers aren't random. They're psychologically engineered to fall below your threshold of concern. The bank knows you won't sit on hold for 20 minutes over $3. They know you won't research new accounts, fill out forms, and move autopay subscriptions over $2. That indifference is the product. Across millions of accounts, those harmless fees compound into billions in revenue, one barely noticed withdrawal at a time. Your brain is wired to ignore small repeated losses while fixating on large singular ones. It's called loss aversion bias, and the banking industry understands it better than you do. A $300 surprise would trigger action, but $3, 12 times a year for a decade? That same money disappears quietly, normalized into the background noise of your financial life. You look at your statement, see a charge you don't fully understand, and shrug. Just the cost of banking, you tell yourself. Everyone pays them. But that response isn't rationality. It's learned helplessness dressed up as maturity. The financial industry has spent billions cultivating an environment where questioning fees feels paranoid and moving your money feels exhausting. They don't need to hide the charges. They only need to make them boring enough that you won't act. And it works. Month after month, you pay for the right to hand them your capital, which they then deploy to borrowers at a markup, while returning almost nothing to you. Then there's the savings account lie. You deposit money. The big legacy banks pay you 0.01% interest, maybe 0.05% if they're feeling generous. You see the number go up by a few cents each month and it feels like progress. It feels responsible. You're saving, not spending. That has to be good, right? You're not saving. You're leaking. That same bank is lending your deposited capital to borrowers at 7%, 15%, sometimes 24%. The spread between what they pay you and what they charge is their profit margin, and it is enormous. You are not a customer in this equation. You are inventory. The distinction matters because it changes every incentive in the relationship. But here's what never shows up as a line item on your statement. Inflation is outpacing those pennies they deposit into your account. Let's be concrete. If inflation is running at 3% and your savings account pays you essentially zero, $10,000 in that account loses $300 in purchasing power over 1 year. There is no deduction, no alert on your phone. Your balance might even look like it grew slightly, which creates a false signal of safety. You think you're standing still, you're sliding backward. This is negative real yield. Money is not just a number on a screen. It is a claim on future time and energy, and yours is being quietly converted into someone else's yield while you sleep now. Let me show you the architecture that proves this isn't accidental. Banks in the United States and elsewhere still engage in a practice called high-to-low transaction reordering. Here's how it works. Say you have $50 in your account. On the same day, you buy coffee for $4, gas for $30, then a grocery charge for 60 hits. Chronologically, the coffee and gas came first. You had enough for those. But some banks don't process them in order. They run the largest charge first. That $60 grocery bill wipes out your balance. Now the gas charge overdrafts. The coffee overdrafts. Each one becomes a separate billable event. Each one carries a fee, sometimes $35 or more. You made one mistake. The system converted it into 3. This isn't a glitch. This is intentional architecture, built to extract maximum revenue from the exact moment you're most financially vulnerable. They don't process largest first because it's more efficient. They do it because it manufactures more fees. And they've done it for years, quietly settling lawsuits when caught, then continuing the same behavior under new names. And still, most people don't leave. Not because switching is genuinely difficult, but because looking at the problem feels bad. Financial discomfort triggers avoidance behavior. You stop opening the statements. You stop comparing rates. You tell yourself you'll deal with it next month. The bank understands this perfectly. Customer inertia is one of their most valuable assets. They count on the friction of leaving being higher than the pain of staying. But there's something deeper running underneath your inaction. You don't resist these fees because resistance would require admitting that you've been paying a premium for your own disengagement. That admission carries shame, and shame is expensive. Most people will continue overpaying just to avoid the discomfort of acknowledging the leak. The system counts on this. It is designed around a behavioral truth. Humans will pay almost anything to protect their self-concept, even when it is costing them their future. So you tell yourself all banks are the same. You tell yourself it's just the cost of being a responsible adult. You keep the account you opened when you were 16 because the app is familiar and the branch is nearby. You think you're being loyal, you're being predictable. And predictable is the most profitable thing you can be. In fact, you think you're being responsible. But responsibility without scrutiny is just compliance. And compliance in a system built on asymmetry is the most expensive choice you can make. Look at the broader pattern and you'll see why this scales so efficiently. Financial institutions weaponize complexity. They bury fee schedules in 40-page documents written in deliberate obfuscation. They rename charges every few years so comparison becomes difficult. They bundle services so you cannot tell which component is bleeding you. The result is a psychological fog. You feel the weight of managing money without ever seeing the specific leak. And because everyone around you experiences the same quiet drainage, it becomes socially invisible. If all your friends pay monthly fees, the fees start to feel normal. Normal is the most dangerous word in wealth psychology because normal is carefully manufactured. It is not accidental that the average person cannot articulate what their bank actually costs them annually. That blindness is a product feature. Your monthly statement is not a report on your financial health. It is an invoice for your own disengagement. Every dollar lost to fees, every fraction of purchasing power eroded by sub-inflation returns is a direct result of a decision you did not make. Not a decision to spend recklessly, but a decision to not pay attention. Across millions of accounts, this quiet drainage aggregates into billions in risk-free revenue. The wealth doesn't disappear. It transfers. It moves from the accounts of working people into balance sheets you'll never see, then into assets, markets, and instruments that generate compounding returns for shareholders. The people losing $3 a month are not the people receiving dividends. This is the mechanism behind the widening wealth gap that economists measure but rarely explain in accessible terms. It is not just about income. It is about the quiet, continuous extraction that happens at the account level every month across hundreds of millions of households. The uncomfortable truth is this: the less money you have, the more it costs you to exist within the system. Minimum balance requirements, low balance fees, high interest short-term lending when you need emergency cash. Premium rates are reserved for people who don't need them. Penalties are concentrated on people who can least afford them. This is not a flaw in the design. This is the design. And until you internalize that, you will keep interpreting your financial struggles as personal failure rather than systemic outcome. So here is the mind shift that changes everything. Stop evaluating your bank on convenience and familiarity. Start evaluating it on whose interests it serves at the structural level. Every fee, every rate, every default setting in your banking relationship was configured by someone whose job is to maximize institutional revenue. That doesn't make every banker malicious. It makes every financial decision you accept without scrutiny potentially costly. The default is almost never set in your favor. You are not a customer in this arrangement. You are a source of capital managed by a behavioral model designed around your psychological patterns, your inertia, and your discomfort with financial confrontation. But the moment you see the mechanism clearly, you stop being a passive participant. Wealth is not built by earning more. It is built by refusing to participate in systems that normalize your own diminishment. Stop seeing yourself as a consumer of financial services and start seeing yourself as someone who commands capital. Know what you're paying. Know what rate you're receiving. Know what your money is doing while you sleep. Compare the yield on your savings to the inflation rate. Look at your last 3 statements and add up every fee. Ask yourself whether that institution is paying you for the use of your capital or charging you for the privilege of holding it. Knowledge in this context is not abstract. It is directly convertible into money that stays in your account instead of leaving it. The invisible tax runs every month. It runs quietly, and it will keep running for exactly as long as you allow the system to remain invisible to you. Once you see the pipeline, you cannot unsee it. Once you refuse to feed it, you stop being inventory. You become a participant, not because you got a raise, but because you finally decided that your money would either work for you or it would not sit still long enough to work against you.